Hello and welcome to the Business Standard Morning Show. I'm Ishan Gera and here are the stories for the day.
रामू दो चाय दे यार।
अरे नहीं यार, एक चाय कॉफी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
SBI का होम लोन, I agree with you.
SBI is the banker to every Indian.
Rising crude oil prices, depreciating rupee, and burgeoning raw material costs have put companies across sectors in a tight spot. But they're now better placed to pass on the rising input costs to consumers. Some have already done it partially, while others are about to. Our next report offers a peek into this inflation conundrum and the effect on consumers.
Just as India decided to end all COVID-19 containment measures from March 31st and the economy started picking up the pace, Russia's war in Ukraine put the brakes on growth recovery. With the surge in prices of crude oil, steel, aluminium, and food items, companies have limited options but to raise prices. Automakers are worried about further price hikes denting demand in segments like two-wheeler. FMCG companies are looking to offset the commodity inflation triggered by supply chain disruptions. Real estate companies like Tata Realty and Shriram Properties have increased property prices in new projects by up to 8% and warned of more increases. Developers also expect borrowing costs to go up in the future. However, it is too early to predict a drop in demand as it has been robust over the past year. The situation does not look rosy in the auto sector, which already witnessed several hikes. The passenger vehicle division of Tata Motors has been able to pass on only 50% of the impact of commodity price rise to the buyers. While the demand has been strong in passenger vehicles, commercial vehicles and two-wheelers have been in a prolonged slowdown. Tata Motors is hiking prices of its commercial vehicle range by 2 to 2.5% from April 1st, whereas Mercedes-Benz India announced an upward revision of 3% in its entire model range.
Demand weakness continued after the second wave impacting the rural sentiment. Particularly, as we have seen, tractor and two-wheeler segment is under more pressure, whereas on the other side, CV is relatively better and passenger vehicle segment is purely outlier with a huge waiting period, even more than 1 year for few products like XUV 700, etc. So accordingly, we believe that pricing power with the automaker is also in a varied fashion. And similarly, two-wheeler and tractor players has a limited pricing power to pass on the cost escalation. Commercial vehicle segment is also witnessing some pressure on the demand side. That's why here the pricing power is also limited. Whereas on the passenger vehicle side, these companies, all the automakers have a reasonably strong pricing power. But we should note that within this segment, SUV segment where the demand is really very high and the segment has been growing in a healthy double digit in past few months, pricing power is reasonable and price hike is taken at regular interval in the range of close to 2% every quarter. Whereas within the passenger vehicle segment, passenger car segment is still under pressure, and here the pricing is very limited, or I would say there is hardly any pricing power. So we expect price hike in a phased manner, which would just cover up 20 to 30% of the cost escalation. Balance 70-80% price related increment would happen in coming quarters, but it cannot happen in a one go.
Domestic airfares have also gone up significantly as jet fuel prices reached a record high. But a strong recovery in air travel has provided a cushion for the sector. When it comes to the FMCG sector, another round of price hike is in the offing. Products ranging from biscuits to shampoos to detergents have gotten costlier, and the ongoing war has only made things worse. The sector is worried about demand taking a hit if prices rise further. Venkatesh Vijayaraghavan, the CEO of FMCG major Kavincare, said that volume growth has been tapering and consumers are also holding back their consumption. Dabur India CFO Ankush Jain voiced a similar sentiment, pointing to consumers relooking at their discretionary purchases while also downtrading to smaller packs.
They have not passed all the costs to the consumer. Surely they have undertaken price increases over a period of last 1 year. So two things have happened. So whatever price that they have witnessed in terms of raw material, they have tried to absorb in the first 2 quarters. Then they initiated price increases because they realized that the price increase is not going to be a short-term phenomenon. Whether they have the pricing power and whether consumers are willing to pay. FMCG particularly is a price-sensitive sector. A lot of volume for major incumbents is supported by rural demand, semi-urban demand, and tier 2, tier 3 demand. And there is a genuine concern around income, private consumption, the ability to spend. While incumbents can increase the price in the hope that on a short-term basis, the consumers are willing to pay. But over a long-term period, sustained inflation, no company can sort of claim that it has the ability to sort of hold on to it and pass on the entire power to the consumer. Now, if it becomes systemic, then there will be a recalibration of a new normal in terms of demand. So accordingly, the value price segment, the mid price segment, the premium price segment will readjust to the new normal.
As consumption remains unstable in rural areas and smaller cities, companies are cautious in passing on the full impact of raw material inflation. For now, they are choosing to hike prices in phases and with some lag, hoping for commodity costs to stabilize over the next few months.
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं?
ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं?
वो तो सबसे आसान है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Supply chain disruption caused by the pandemic is also one of the reasons for soaring input costs. Meanwhile, 2 years ago, on this day, Prime Minister Narendra Modi had announced a 21-day lockdown. The COVID-19 virus had just started wreaking havoc, and we were staring into the abyss like the rest of the world. In the next 2 years, the virus caused unimaginable sufferings, claiming over 5 lakh lives, derailing the economy, and leaving millions unemployed. Now, as India surges back to the normalcy, we're looking at how the pandemic has altered the way Indians live, work, consume, and do business.
Prime Minister Narendra Modi appeared on TV on the night of 24th March at 8 to announce the 21-day lockdown beginning midnight. With just 4 hours left, anxious people stormed grocery shops, medical stores, ATMs, and even liquor vents to get their fill. From 25th March, public transport came to a standstill, leaving migrant workers in big cities with no other choice but to walk. So they walked. Moving stories and disturbing visuals of exhausted families, with children in the tow, streaming out of metros and walking towards their homes, flooded the newspapers and TV channels. And it was just the beginning. The toll that the contagious virus extracted on lives was unparalleled in recent Indian history. Official estimates say that over 5 lakh lost their lives in the next 2 years. Some believe that the death toll was way higher. The March 24, 2020 lockdown was the first in the series of many which came later. Now, 3 waves, 2 years, and several lockdowns later, life is springing back to normalcy. And so is the economy. However, COVID has left a lasting impact on our lives. Perhaps one of the most visible and lasting impacts that the pandemic has had is on how Indians and people across the world view work and the workplace. While the hybrid model is here to stay, it is going to be sector specific. For example, companies in IT and allied industries will continue to work in a hybrid model. In fact, according to a survey by NASSCOM and Indeed, 70% of IT companies are trying to employ the hybrid model effectively. Flexible work is another model that has gained acceptance. Hindustan Unilever, India's biggest FMCG company, has introduced a new flexible work model. Under the scheme, employees would have a flexible association with the company. but still receive financial, security, retirement, and medical benefits. The worker will get a monthly retainer. In addition, he or she will get paid for each assignment. And between assignments, they are free to do other things that are important to them.
The pandemic, if we look at it, it has got two perspectives. One is an employee perspective, the other one is an employer perspective. From an employee perspective, I think there has been a disruption when we talk about the way we work and how hybrid work and work from home have actually become the terms which employees are using across the industry on a day-to-day basis. So what I foresee will continue to happen is people will be more focused towards working from home. Flexibility will remain there. And also they will focus on the mental health, because that's what this pandemic has taught all of us, that we need to focus on our physical and mental stability as well. From an employer perspective, I think the pandemic actually accelerated the adoption of technology, and the future will be all about the right combination of technology and human intelligence. Whether we talk about talent acquisition, we talk about talent management, automation will play a very significant role. And the employee engagement will also be a key factor what organizations would be looking for across the globe. And the virtual town halls, the constant communication, more liquidity of information will continue to happen, and the organization will keep on focusing on employee health benefits, financial and physical well-being of an employee.
The pandemic has also left a lasting impact on what we consume and how we consume. The Boston Consulting Group interviewed consumers during the second wave of India's COVID-19 outbreak. It then compared that survey with its previous one from August 2020. It also compared the findings to data that it had collected during the pandemic's first phase. The group found that there are accelerating behaviors which increased rapidly after the initial COVID outbreak and continued to increase as time passed. For example, the number of consumers who purchased nutritional supplements and healthier packaged foods for the first time surged by around 30% during the first stage of the pandemic, and this was still rising as of late May 2021. Then there are sustained momentum behaviors. These include the use of a wide array of digital services, use of e-commerce, digital wallets, online educational classes, paid over-the-top media services, and free online video apps like YouTube jumped early in the pandemic. By the time of the second wave, their use had settled at those elevated levels. These behavioral changes are more permanent than others. As a result, the market for these services is likely to remain robust even after COVID. This is good news for the likes of Amazon and Bear Juice. There are also sensitive behaviors which tend to change in response to the intensity of the pandemic and lockdowns. For example, relying on online doctor consultations. According to BCG, the strong growth seen in doctor teleconsultations compared to visiting them in person is unlikely to continue after COVID. Lastly, there were transient behavioral changes. These gained significant traction during the early stages of the pandemic but didn't last. Examples would be online fitness and hobby classes. The pandemic may also change how we do business. India Inc., like the rest of the world, will have to re-evaluate established notions about scale and global supply chains. In India, before the pandemic and even now, there has been a call for greater integration with global supply chains. Consequently, the focus has been on large formal enterprises that can leverage their heft to play a significant enough role in said networks. It is also felt that India could benefit from the shift in global supply chains away from China in the aftermath of COVID-19. And while that will hold true, there could be a more fundamental shift in store as companies reorganize how they obtain their goods and build resilience. As the Harvard Business Review explains, while dealing with the topic of global supply chains in a post-pandemic world, there is a rise in economic nationalism. According to it, manufacturers across the world are going to face greater competitive and political pressures to increase their domestic production and increase employment in their home countries. They will also be expected to either reduce or eliminate their dependence on sources that are deemed to be risky. As a result, India Inc. and the government can not only focus on greater integration with global supply chains. Instead, alternatives will have to be found and pursued in parallel.
Now, the whole world is saying actually we need locally resilient economic systems in which smaller actors, and they'll have to be smaller because their markets are less, will have to be working with each other in clusters of economic systems. And in that will grow, like I'm saying so, smaller enterprises will grow, will thrive, informal enterprises will get more recognition and will thrive along with the larger ones within those systems. So that is the trend. And that's why, whether it's the US or Europe, they're talking more about, building their own Atmanirbhar. And our idea of Atmanirbhar, which was before the pandemic, was being poo-pooed by many economists to say, oh, we are going back to being protectionist. It wasn't about being protectionist. It was about being reliant, self-reliant. And we need that. The whole world is recognizing that each part better be self-reliant because it cannot rely on the others to keep connected with it.
In the post-pandemic world, people will be more focused on striking a balance between work and life. The embrace of digital tools and channels for making purchases will rise, with a heightened focus on health. And last but not least, a re-evaluation of how and where to build our products and services is necessary.
क्या हाल? मत पूछ यार, फिर से स्टॉक्स में फंस गया।
तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The increase in prices of commodities has indeed begun weighing on most sectors. One such industry is cement, which is facing the heat of high input costs amid concerns of weak operational performance in the near term. Given the uncertainty, here's how investors can play the theme.
The cost of the Ukraine-Russia conflict is being paid by global economies. The conflict, which began nearly a month ago, has pushed up prices of various commodities. Prices of building material, for instance, have increased significantly in the past 3 weeks owing to the conflict and supply chain bottlenecks in Australia. International petcoke prices rose 57% in the past few weeks and could rise further if coal prices remain elevated. Moreover, the rally in crude oil prices will also lead to more hike in diesel prices. One of the key users of these raw materials is the cement sector, which has been seeing consistent price hike since November 2021. The sector has exited the December quarter on an already rough patch, marred by weak demand. The geopolitical crisis has only weakened the near-term outlook further. On the bourses too, cement stocks have corrected sharply in the last few months. The likes of JK Cement, Ambuja Cement, Ultratech Cement and ACC have plunged up to 31% thus far in calendar year 2022. In comparison, the BSE Sensex has slipped about 1% during the same period. These higher costs, analysts say, will impact cement earnings in the near term. Global brokerage Jefferies has cut its FY23 operating profit estimates for the sector by 19%. It said earnings visibility has sharply declined for the Indian cement sector due to the unprecedented increase in costs. The industry needs to take an 8% price hike for every $50 per ton increase in coal plus petcoke prices just to maintain its operating profit per ton. That said, analysts believe that the current headwinds are transitory in nature as likely price hikes by companies will help aid their margin pressures over the midterm. Besides, they feel the current elevated international coal and petcoke prices are unsustainable in the long run. Let's listen to Gaurang Shah of Geojit BNP Paribas to understand his take on the sector.
So even if the concerns are there in terms of earnings dent, I don't think it will be a prolonged kind of hit for the cement manufacturing companies, because eventually they'll pass it on. In terms of offtake of cement, I expect a good month-on-month numbers over the next couple of quarters, given the fact that, number one, you have government spending on infrastructure. You have the announcement made by the Honorable Minister that 25,000 kilometers of road are going to be constructed. Now that all is going to be by default cement concrete roads. And you have other schemes which the government is spending where cement consumption will be high.
Vishal Periwal of IDBI Capital expects cement players to hike price for the April-June quarter in line with the recent increase in diesel and petrol prices.
Now, on the positive side, what I find is that demand is still strong. Okay. And then second is the price hike, it was muted till now. But I think today, the central government, they have increased the petrol prices again, cylinder and all, they have increased. So historically, what I have seen is when the central government start increasing the prices, and then the other player, whether you talk about any other industry, they start increasing the prices for them.
Shah of Geojit BNP Paribas sees cement stocks as contrarian bets. He advises investors to buy select stocks in a phased manner.
So when the market is underweight, I think you should think out of the box that these situations are not going to get prolonged for a longer period of time. Be stock specific, concentrate on large cap first and then the select mid caps, and whatever dips you get, start allocating maybe 25-30% now, and as you get corrections, you may add on to the stocks.
ICICI Securities, meanwhile, is bullish on Ultratech Cement, ACC, JK Lakshmi and Sagar Cement. In nutshell, cement stocks are likely to trade range-bound in the near term, driven by volatility in commodity prices. However, the sector is expected to see gradual reset in profitability, underpinned by improving demand-supply dynamics, better price discipline and cost optimization, and de-risking efforts. On Thursday, weekly F&O expiry back home and US President Biden's meeting with NATO members will be keenly watched by the markets. Besides, they will also track the two-day European Council meeting on further cues regarding banning Russian energy imports.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Pandemic disrupted the market's dream run and led to loss of lakhs of jobs in the informal sector. But at the same time, it gave rise to the jobs in the gig economy. Our next report tells more about this sector and its workers.
On Monday, Zomato announced a pilot project to deliver food in just 10 minutes. It will kick off in Gurugram from next month. People on social media slammed the move, alleging that it will put the lives of their delivery partners in danger as they will rush to meet the target. Congress MP Karthi Chidambaram was also quick to criticize the move, calling it a 10-minute long gamble with a gig worker's life. The Lok Sabha MP had recently asked the government to regulate gig economy companies like Swiggy, Zomato, Uber, Ola and Blinkit and protect riders who work for them. Zomato, on its part, stressed that it would not pressure its drivers to deliver food faster. The plight of gig workers who deliver food, drive cabs and provide professional services for app-based platforms has come into the fore in recent times as they increasingly dot the Indian roads. So who are these gig workers and what is the gig economy? A gig worker is a person who performs work or participates in a work arrangement and earns from such activities outside of the traditional employer-employee relationship. The gig economy encompasses freelancers, online platform workers, self-employed, on-call workers and other temporary contractual workers. Gig workers get the flexibility to work for several employers at the same time. A gig economy can benefit employees as well as companies. While workers can choose the projects they want to be associated with, companies can manage costs by adjusting their flexible workforce based on the demand. The rise of the gig economy is driven by the emergence of tech-enabled platforms, demand for flexible work arrangements, and focus on skills. According to a 2019 report by the India Staffing Federation, India is the 5th largest in flexi staffing globally, after the US, China, Brazil, and Japan. While the gig economy is prevalent among blue-collar jobs in India, the demand for gig workers in white-collar jobs, such as project-specific consultants, salespeople, web designers, content writers, and software developers, is also emerging. Gig workers work on various compensation models, such as fixed fee that is decided during the contract initiation, time and effort model, actual unit of work delivered, and quality of outcome, or a combination of these. India is currently estimated to have more than 15 million freelance workers engaged in projects in different fields of the gig economy. The gig economy can serve up to 90 million jobs in the non-farm sectors in India, with a potential to add 1.25% to the GDP over the long term, a report by consultancy firm BCG had said. It also states that gig workers are relatively younger and less educated compared to non-gig workers. They typically work for limited hours in a day, with 61% of gig workers working less than 8 hours a day versus only 11% of non-gig workers.
यार आइसक्रीम खाएं? नहीं यार, कुल्फी।
We Indians disagree on everything, but we agree. SBI is the banker to every Indian.
अरे SBI contactless debit card? I agree.
SBI is the banker to every Indian.
Over 78% of gig workers earn less than 20,000 rupees a month, while only about 50% of non-gig workers in similar profiles of work earn in the same range. That's all we have for you today. For more news and analysis, log on to businessstandard.com. We'll be back tomorrow with our next episode. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.